Have you ever wondered how the IRS targets high-income earners? If you're earning over $1 million a year, particularly as a business owner, the IRS is paying closer attention to your filings than the person that's making substantially less. In this video, I'll walk you through what I believe the IRS is currently focusing on, how high earners are being targeted, and what steps can help you reduce your audit risk while staying fully compliant. Thanks to enhanced enforcement budgets and advanced AI auditing systems, the IRS has said that it's stepping up its enforcement game, setting its sights on specific taxpayer groups with renewed focus on combating tax evasion and generating additional revenue for the U.S. government. By focusing audit resources on high value and complex cases, the IRS aims to send a message to the wealthiest taxpayers. I'm Omar Morillo, founder of Imperial Wealth Advisors and a certified financial planner. We work closely with 7- and 8-figure entrepreneurs to help align their tax strategies, business structure, and compliance protocols in a way that seeks to support both growth and defensibility. So let's start with first addressing the IRS's new target profile. What are the strategic shifts in enforcement? The IRS has increased focus on entrepreneurs and business owners reporting $1 million or more in annual income, particularly those with multiple business entities, large deductions, and cross-border exposure. With tens of billions in IRS funding, audit resources have expanded significantly in the last few years. Sophisticated algorithms are replacing random audits with data-driven targeting. If your tax profile falls outside the statistically expected norms, the odds of review or audit rise sharply. In short, size, complexity, and inconsistency are now the risk factors, not just income. So, who's most exposed? I believe some of the highest audit risk today includes entrepreneurs who file multiple K-1s across S corporations and partnerships, business owners claiming significant deductions tied to travel, vehicles, or home offices, operators in industries with historical audit interests such as medical, legal, consulting, real estate, and digital services, high net worth individuals with foreign accounts and/or digital assets activity as well. So what's the common denominator here? Complexity. So that brings us to section number 2. What are the common red flags for high income returns? The IRS isn't just looking at your income anymore. They're analyzing how it was earned, how it was reported, and how your deductions align with your income bracket and industry norms. So here's what I believe are some of the most common triggers. Income reporting inconsistency. Discrepancies between your reported income and third-party data, such as your 1099, your W-2, your K-1s, etc. Underreported investments such as crypto or foreign income, and mismatches between lifestyle and income disclosure. So here are some deductions and credit hotspots. Large business deductions without any records, aggressive depreciation schedules or passive loss claims, excessive home office, auto, and/or meal and entertainment write-offs, charitable contributions that aren't adequately substantiated. That brings us to the next section. What are some proactive defense strategies that could work? At this level of income, tax planning is no longer just about saving you money. It's about risk management. So, number 1, start looking at documentation as defense. Maintain a real-time, audit-ready archive of expenses, contracts, supporting information, and documentation. Digitize everything. Utilize document management software or vaults rather than relying solely on folders on a desktop. And confirm major deductions such as charitable gifts, property acquisitions, income allocations with third-party records. Number 2, be strategically consistent. Ensure that your entities use consistent accounting methods unless justified. Align your personal and business filings because IRS AI tools can automatically cross-reference entities and individual returns. If you take a complex position, obtain a written tax opinion. This creates a documented basis for your rationale. And number 3, know when disclosure is better than deduction. Sometimes not claiming a deduction is the more strategic move. Disclosing gray areas such as foreign holdings, crypto, or passive losses can mitigate penalty or even prevent audit escalation. So, in closing, how can you navigate this landscape with confidence? At this level of income and complexity, tax planning is about more than just numbers. It's about controlling risk while preserving flexibility. Understanding how the IRS selects high-income returns for audits and aligning your strategy accordingly can provide you peace of mind and may help provide some long-term protection. If your current team is reactive or your filings are becoming increasingly complex year over year, it may be time to reassess your approach. So send me a message or click on the link below to schedule a private review with our team. What we'll do is look at how your tax posture stacks up in today's enforcement environment and what, if any, proactive moves may help you stay ahead of the curve, because the cost of being unprepared isn't just financial, it's operational. Thanks for watching.